Would you like to give away half of your money to Uncle Sam in retirement? No? Well, then you need a Roth IRA account. So here's the three things I'm going to go over today. First, we will talk about what a Roth IRA account is, and I'm going to talk about the three different tax buckets and how Roth is really one of the key tax buckets when it comes to retirement investing. Second, I'm going to talk about a case scenario, and I'm going to demonstrate to you how you can lose 20% of your entire invested amount in capital gains taxes over the years unless you put this money inside of a Roth IRA. And third, we are going to go over the IRS contribution limits for 2025 and 2026. Hi, and welcome to the Money Matters MD show. I'm your host, Dr. Abhishek Gadre. I'm a practicing pulmonary and critical care physician, and I absolutely love to talk about personal finance topics. So what is a Roth IRA? Well, Roth IRA stands for Roth Individual Retirement Account. So everyone who makes a wage has access to this account. And basically, money is contributed after paying taxes, and money in this account grows tax-free. And at the time of withdrawal, you don't pay any taxes on it at the time either. So let me explain to you what the three different tax buckets are when it comes to retirement investing. The first tax bucket is the pre-tax bucket. So this is your traditional 401k that you're familiar with and the traditional IRA. So the traditional IRA is the traditional individual retirement account. And both of these traditional IRA and traditional 401k accounts are pre-tax accounts. You put money in before you pay any taxes on it, and any contributions are deductible on your income tax. And money grows completely tax-free, but you pay taxes at the time of withdrawal in retirement. So typically you cannot access the funds until you're 59 and a half. And think of this account as a joint account between you and Uncle Sam. And Uncle Sam means the IRS. And IRS can determine what the future tax rate is going to be. And when you're in retirement, you'll basically pay the tax rate at the time. The second type of tax bucket is a Roth bucket. So the examples of a Roth bucket are a Roth IRA, which is the Roth Individual Retirement Account, which is a counterpart to the traditional IRA. And the second type of Roth account is a Roth 401k, which is a counterpart to your traditional 401k. Now, in a Roth account, you put money after you've already paid taxes on it. And money grows completely tax-free, and you never pay any capital gains on it. And again, you have access to it in retirement at 59 and a half and later. But when you're withdrawing money down, you don't have to pay any taxes on it at the time, regardless of what your tax rate is. And even if this money is inherited by your heirs, they don't pay any taxes on it either. So this is an incredibly powerful account. The third type of tax bucket is an after-tax bucket. So this is your typical taxable brokerage account. In this, you put money which you have already paid tax on, just like Roth. But the difference is in a taxable brokerage account, the gains, the capital gains on any growth that you will have is completely taxable. So let me explain the difference between a Roth IRA account and a taxable brokerage account using a case scenario. So let's say you started investing $1,000 a month and you invested it total for about 30 years. So total you invested $361,000, and let's say you got an average 8% return. The total investment by the time you retired actually became around $1.5 million. That means more than 3/4 of what you actually ended up with is growth. Well, here's the good news. You did really well and you made a lot of money. Well, here's the bad news. You owe a lot of taxes. So the 76% of $1.5 million that you ended up with, you owe taxes on that amount. And this tax is called the capital gains tax. Capital gains tax is anywhere between 15 or 20% of the entire growth that you had in your investments, and that depends on your income levels. There's even an additional 3.8% NIIT surcharge depending on your income levels. So you may be paying up to 23.8%. And this is the current tax rate. And the capital gains taxes can change in the future. So you have to know what you actually owe. So there's two take-home points from this case scenario. First, that you don't just want to save over a long period of time. You actually want to take advantage of compound interest, which is responsible for more than 3/4 of the entire amount that you ended up with in retirement. And the second thing is you also don't want to pay taxes on more than 3/4 of the entire amount that you end up in retirement. You want to take advantage of tax advantaged accounts like Roth IRA. So who can contribute to a Roth IRA? The YouTube analytics tell me that a lot of you viewers are not actually my subscribers right now. If you would like to support my channel, please hit that subscribe button and like and share my video. So anybody who's working and has a wage can contribute as long as they make below a certain amount. And these numbers are published every single year. So for 2025, as long as you're single, you make less than $150,000 a year, you're eligible to invest in a Roth IRA. And as long as you make less than $236,000 as married filing jointly, you're able to contribute fully to the Roth IRA account. Now, just as an example, if you are a medical trainee, you're an intern or a resident or a fellow, you very likely make less than this particular cutoff, and you should every single year contribute to a Roth IRA account. When you become an attending, you will most likely cross this particular threshold and you will no longer be able to contribute to Roth IRA directly. But don't worry about it, because you will still be able to do a backdoor Roth IRA, which I'll talk about in a future video. You just can't contribute directly. And for you attendings out there, I wish there was a video in which somebody showed me step by step how to do a backdoor Roth IRA conversion. For high income earners or attending physicians, I'm going to make a whole separate video and I'll go over step by step how to get started with a backdoor Roth IRA, and I'll attach the video here once it's published. So let's talk about how much you can contribute in a Roth IRA account. So in 2026, you can contribute up to $7,000 as an individual. Now, if you're older than 50, you get additional $1,000 of catch-up contribution, so you're able to contribute up to $8,000. Now, the 2026 numbers have not been published final yet, but these are projections made by experts, and the contribution amount is expected to go up to $7,500 for 2026, and the catch-up contribution will go from $1,000 to $1,100, and I'll update these numbers once the final numbers are published. Now, remember, if you're married, you will be able to contribute up to $14,000 because you can contribute $7,000, and your spouse, as long as they're also employed and have a wage, can also contribute $7,000. So when I was an intern, I had no idea what a Roth IRA account was, but somebody just made a passing remark and they said, you know what, you should invest in a Roth IRA account. And I said, sure, I'll figure it out. And I went to my Fidelity website where my 403B account was from residency, and I opened the Roth IRA account. I went ahead and connected my bank account and put in $200. And I was really proud of the fact that I did that. By the time, 3 years later, time came to graduate from residency, and we were trying to figure out and consolidate all of our retirement accounts for our new job, that $200 was still sitting there. Guess what? I completely forgot to actually invest it. So remember, you guys, don't just put money in a Roth IRA account and forget about it. You actually have to take the next final step and invest the money in a mutual fund or index fund or ETF. Do something with it. So here's the 5 take-home points for you guys. Know the 3 different tax buckets, all right? So know what pre-tax is, know what Roth is, know what after-tax is. Second, Roth IRA account is an incredibly powerful retirement account in which money grows completely tax-free once money is contributed to it. Number 3, up to 3/4 of the entire amount that you will end up with in retirement might not be what you even contributed. It comes from compounding and investment growth. And only 1/4 might be the part that you actually contributed. Point number 4 is you will owe taxes on any amount of growth that your portfolio has shown. And capital gains taxes can be up to 3/4 of your entire portfolio, which is a massive amount. And that's where Roth strategy comes into play. And lastly, don't forget to invest money once you put money in the Roth IRA account like I did. Just remember, just pick an ETF, pick a mutual fund, pick an index fund, pick something, and go ahead and invest it and do it every single year. All right? If you learned something useful today, please like and share my video and subscribe to my channel. Money Matters MD, over and out. The Money Matters MD show is for educational and entertainment purposes only. This is not financial, legal, tax, or medical advice.